And yes, the Fed is going to cut because they'll be following short rates down. So the T-bill rate can get down towards zero again, and the Fed will follow with its Fed rate cuts down to who knows whatever they get to.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. Special treat, Bob Hoye, economic historian extraordinaire, is with us today to explain the credit bust, where it's heading, where we're going, and put it in historical perspective as well. Bob, it's always great to have you on. So the credit bust.
Okay. Thanks for your very kind introduction. And really, without having financial history, it's very difficult to put this incredible financial violence in perspective. And on top of that, you've got the COVID shutdown, which was enormous and really threw a scud into things. So, but within it all, you know my theme, Kerry, that a great financial bubble has been accomplished. And you can compare this to 1929 and on the way up and with the crescendo, or 1873 was a bubble year. A major bubble completed in 1825. And then before that, 1772, and then you go back to the first bubble, the South Sea bubble in 1720. So in researching these decades ago, I found that there was some very common items as these fantastic bubbles completed. And one of them was in the final year of the Fury, gold's real price would go down. So gold stocks then became underperformers as new things were celebrated. Even in the 1720 bubble, new concepts were celebrated. And then another one, in some of the later bubbles where you can get the price of copper, copper's real price goes up in the final year or so of the bubble, which it did this time, and that also represents base metals and other commodities. And then these reverse. So you now have gold's real price from going down, which was appropriate, is now going up. And you've also had a hell of a whack to copper's real price.
Right.
Now, another one of the identifying features of post-bubble contraction is that real long interest rates go up. Have interest rates gone up? Yeah. And then the really sneaky one is that the senior currency becomes chronically firm. That's against most other currencies and most commodities. And this has also been the case. But where the financial markets, the stock market blew out in January 2022, and you had a mighty whack to both stocks and bonds. And then for this year, you've out of the major hit to the markets in October, you've had a very good, even say outstanding counter-trend rally. And this is not like the first year after the peak of a bubble. There should be more contraction in it. But this is where we get back to when the authorities did the lockdown, which was unprecedented. You've got many people around the world trying to get back to normal. And then in the U.S. and Canada, that's really making the employment numbers look good. So, but that is artificial, a rebound from the artificial hit with the COVID. But so we're going to stay with our four key items, and they're saying we are in the direction of a contraction. And then more recent business cycle research is that I've got the yield curve, which is the difference between short rates and long rates. I've got the curve in charts all the way back to 1857. And there is two very distinctive rules. If the curve inverts, you get a recession. And the curve did invert.
Certainly.
The other rule is that
It certainly did. No question about it.
It certainly did. And then the other rule, subset to that is that if the market forces are fairly intense with the inversion, the more intense the action, the more severe the subsequent contraction. And I just sort of jokingly say, well, maybe it was about a 3/4 intense. But both are effective. And what we're watching for now is in the fall after all. Well, we figured that the counter trend recovery out of the last fall's hit could be in place through to mid-year. It's sell in May and go away. I mean, it's a seasonal thing. Now, where we make the seasonal thing effective is that on the leading items, the NASDAQ and, the 6 or 7 supremely hot stocks, well, they're generating technical excesses on the upside. And we've got two measures on this. The one is upside exhaustions, which we're getting, and that's based upon momentum. And then the other is based on some other researchers' work, and it gives sequential sells, and that's based upon pattern. So we're getting both. So at about the right time. So our game has been is that whatever it gets to in the summer, and it would be wonderful if you got technical excesses, which we've got. Now, without the technical excesses, Kerry, you'd expect the trend to continue. But we got the technical excesses. So that with the yield curve and other things suggests that after August, the financial markets can get into perhaps another phase of distress. The street's kind of anxious about the Fed raising interest rates, and I always enjoy pointing out that the Fed actually is following the natural rise in money market rates, and you can do that through the 3-month bill or the 6-month bill. And then once the high in let's use the 6-month bill is reached and it rolls over and starts to decline, that will suggest that the party is about to fail. And then that would be followed by the Fed cutting rates. But, I saw one the other day that, when the Fed starts to cut rates, everything will be fine. And I had a collector's item on that one in September 2007 and used it in our letters. And it was essentially the same notion that after the distress of the Fed raising rates, they would soon cut rates and all would be well. Now, this is just plain intuitive. If you looked at the charts, Kerry, every boom, short rates go up. And when the boom is over, short rates go down. And indeed, when the short rates are really falling is during the worst part of the hit. But spokesmen in Wall Street over the next month will be saying, yeah, the Fed's going to cut and all will be well. And yes, the Fed is going to cut because they'll be following short rates down. So the T-bill rate can get down towards zero again, and the Fed will follow with its Fed rate cuts down to, who knows, whatever they get to. But it won't be igniting a boom. It'll be the consequence of a contraction. So here we are, and the Fed has been the most reckless in its history, again prompted by exceptional circumstances, COVID and all that sort of stuff. But the only thing the Fed knows is to increase currency and credit. It can't do anything else. That's all it knows. So and of course, the tout on the Fed is all, this goes back to before the Fed was formed. The powers that be in the financial center in New York and in Washington, D.C., they all knew that when you had a financial crisis, it was followed by a recession. So they then came up with the theory that with the Fed as lender of last resort, they would trim the possibility of a financial crisis and there would be no recessions. Well, there's been 18 cyclical recessions since the Fed opened its doors for business in January 1914. It only needed one of those to disprove the theory, but the belief continues. And then on this next one, post-bubble contractions can be extremely nasty. And the folks are going to look at the Federal Reserve and say, you spent trillions of our dollars trying to prevent bad things from happening. And this is really nasty. So I see the Federal Reserve system being reformed. And the reform would be putting them back on a gold standard. It doesn't prevent recklessness, but it limits their ambition. So that's quite a statement. Hey, going back to a gold standard. I think it's
what
possible.
are the odds? What are the odds, really?
Inevitable.
Inevitable?
Yeah, the public.
When?
Yeah. The public's going to reform intrusive government.
That's a last resort.
The tool of intrusive government has been a reckless central banking.
Yeah, that's the greatest power they have, is the power to print money, to tax, and all that good stuff. But here's a question. Obviously, the dollar has been strong. Does it keep being strong because everybody just goes to it because the euro and the yuan and all that good stuff and every other currency is going down the drain, and then the dollar is the last thing to go?
Yeah, well, I've tried to explain it, and I think to me, the best explanation has been that during the financial bubble, it's not just equities. Equities gets all the media, but you have a huge bubble in debt.
Assets. Yeah.
And most of the debt is written underwritten in the financial center, which is New York, and due and payable in U.S. dollars.
Right.
So the whole debt bubble itself is a short position of dollars. And then eventually gets to the point, whether it's a country debt or a corporate debt, each institution has to sell something in order to get their hands on a dollar to meet their obligations in New York. Mm-hmm. So there's another thing that also puts a bid in for the senior currency, and that is in a financial storm, the really careful money goes to the most liquid items, and that today is shorter than 1 year U.S. Treasuries, and that then puts a bid in for the dollar, and the other liquid item is gold, and that puts a bid in for gold. So overall, over the next year, I don't see much change in the dollar price of gold.
Okay, so next, look at China. All right, you think we have a bubble? You think we have a bubble? What's going on there? I mean, every single asset class, they printed up way more money than even the United States.
Yeah.
Every bank in the entire country is insolvent. Then you got the demographic collapse where their population for the first time ever is going down due to a number of factors we don't need to get into, but among them the one-child policy. Now they're begging people, please breed, and nobody wants to. They can't afford it. Their real estate market, way more inflated than ours and Ponzi-esque, where people are taking out mortgages to pay for properties that aren't even yet built. And they put our definition of a bubble to shame. So how much worse is it going to be in China?
Well, they've got all of the hundreds of empty apartment towers.
Thousands.
And they're starting to tear them down. But I think it was 2006 when Jim Grant, Grant's interest rate advisor, put together a terrific study of real estate in Manhattan after 1929, and he used the Excelsior Life Building. And the nub of it is that the equity holders went broke, and those providing the mortgage went broke. Then there'd be a new set of equity holders and mortgage people, and they kept going broke until the 1950s, when then it finally washed out, and whoever took over the Excelsior Life in the 1950s was perhaps on side by about 1960s. So that's real estate in Manhattan, and it would represent real estate in many of the large cities and stuff like that. So, real estate is a feature of a post-bubble world.
It's actually worse in China because they got these tofu dreck buildings. They call them tofu dreg. And these buildings they aren't even built. They're falling apart. You see YouTube video after YouTube video, whole blocks of apartment houses literally collapsing. And it's down
in shocking. And then maintain, they fall apart.
And even then,
and of course, we've got the example of downtown San Francisco, where local governments and state governments have made one of the finest cities in the world unlivable downtown.
Yeah,
and you've got property, empty office and hotels and stuff there. It's a disaster.
Yeah,
but it's all part of a post-bubble contraction. And then also, particularly peaking last summer, was that there were going to be shortages of everything forever, and inflation was back on, and all of that stuff. And there's been a huge jump in grocery prices is the latest problem, and gasoline and stuff like that. But I suggest that will stop, and you've had pressures on commodity prices. And let's take one that we worked over in November, which was the lithium.
Everyone loves lithium.
Story.
Everyone loves lithium, right?
In the middle of November, the high for lithium was 600,000, and then it crashed down to about 200,000. And now it's rebounded, maybe 250,000. It's been a few days since I looked at it. But that's a mighty crash in a commodity that was highly promoted. And then, as I say, after August, most ordinary commodities, your base metals. Grains may be okay. There's some technical work that Ross did on each individual grain the other day that could be okay. But generally, commodity prices will weaken seriously after August. So, and again, that's part of the senior currency becoming firmer because the world is short the dollar. So, it's going to be interesting, and it's going to seriously tarnish the theories about economic intervention and intervention of central banks and all this sort of stuff. As I say, I think the Federal Reserve is going to be forced to go to gold convertibility.
Yeah,
it happened before.
So what will that do to the dollar?
After the 1860s, huge commodity boom. I think the high was 1864, and then you had the financial bubble that blew out in 1873. And then the contraction started, but the inflation was huge because of printing greenbacks. And then President Grant just issued an instruction that no more greenbacks will be printed, and they will be redeemable for gold at a certain date. I think that was in 1878. And going into this, the street was fearful. There wouldn't be enough gold. But on the first few trading days of the being, you could redeem your dollars for gold, there was more dollars went out and gold came in because, again, it's more convenient to use a currency note than to walk around with your pockets full of gold. So we've been there before, and then the U.S. was back on a gold standard. And also there was a brief period in England where in 1797, with the threats of Napoleon, the French Revolution, and then the Napoleonic era, and the Bank of England went off of gold, and they went back on in 1819, and then maintained the gold convertibility, I guess, until about 1931 or 32 in there. So it's the answer, and it's the gold convertibility is not perfect, but it's the best. It is the best tool you can use out there to limit the ambition of central bankers. And these central bankers, of course, delight in explaining and hating the gold standard because it curbs their ability to act. And the acting in their mind is managing the economy. But the problem is they see danger around every corner and inflate all of the time. And then that's when you get the currency depreciation. So the point of a gold standard, the point of a non-gold standard is so the Federal Reserve can manage the economy, which has been clearly a failure. So the point of the gold standard is to manage the ambition of the central bankers. Right. And I'm looking forward to it.
It can't happen soon enough, Bob. So getting back, what does the price of gold go up to if they have no other choice but to revert to a gold standard?
Whatever the market's trading at on the day that you're back into a gold standard, the market will know what price it is, and it'll be there, and that'll it. The point is, you don't have to have $1 worth of gold backing every $1 worth of currency out there. You just have to have the full faith and conviction of the Treasury that it will be meet all demands for conversion. So it happens. It's hard to explain, but so with no price change or very little price change in gold in U.S. dollars, how can I be so bullish on gold stocks? And this gets us to the real price of gold, where you take gold and deflate it by the consumer price index, or even better, the commodity index, the CRB, and because it reflects the basic cost of mining. So if you've got the CRB falling relative to the bullion price, your costs are falling relative to the bullion price. And this gets even clearer when you focus on crude oil. So we took the price of gold and deflated it by crude oil. And since the low last year, it's up something like 60%. So if you're a gold miner running at a constant rate of production, those costs should be falling. And let's look at those costs of mining. About 60% of mining costs are energy related. You've got huge diesel trucks and excavators, and you got drills and underground drills, and then you've got the cost of running a mill and even blasting agents relate to hydrocarbons. So it all comes down to crude oil. So in my case, with crude oil falling about 60% relative to gold, existing gold miners should be making money out of that just because their margins are improving. Now, this has been the feature of every post-bubble contraction. Gold's real price goes up as the costs go down, making it, so to speak, the only game in town. Now, this will also feed off into exploration bets because the improving profitability of gold mining also factors into a geological engineer's calculation of the rate of return of a newly discovered gold deposit. So it affects the exploration as well. So I'm very bullish long-term on the gold sector. And within that, there will be some exploration stocks that will be of a world scale where the whole world will be playing these gold discovery stocks, and that'll be a fun time. Now, also, doesn't necessarily mean good news for the silver stocks. I know that every year the silver bugs go crazy because there's always these obvious shortages in silver. But that doesn't work because underneath it all, the ratio between gold and silver I've called it the metallic credit spread. So in a boom, the ratio between gold and silver, it goes down. And then in a bust, it goes up, where silver underperforms gold. And this then is another feature of a post-bubble contraction, is that silver falls relative to gold. And that makes then many of the silver stocks potentially poorer players than a really good equivalent gold story. So the silver stocks will be more in the background, and the main play will be in everything gold, from the senior stocks right down to exploration juniors. So,
right. Okay.
Which is a field I really like. I got my start. I had summer jobs in the field when I was taking geology, and two of those summers was working for a junior exploration company. So they paid me to go to school.
Nice. Hey,
so to speak. And I've always had a regard for exploration stocks since, and I've also had a few very, very good ones turn out, big ones, huge gains, wonderful stuff.
So is Newmont the play here? Is Barrick the play? Agnico Eagle? Or do we go for the juniors as well? How do you allocate?
Well, for retail accounts, they should be looking at some of these small cap gold stocks. We've got a list of about 12, so anybody's interested, they can get in touch with us or through you, and we'll be pleased. And the list is, we keep it up to date, and we put charts on it from time to time. And the list ranges from small cap producers, small cap pre-production, and small cap exploration bets. So it kind of covers the picture. Now, it was 1995, I think, when I got the urge to think, I think we're going into an exploration market for the gold stocks. So I checked with a few of the guys who were actually managing gold funds, and I got a list of 5 junior stocks, and one of them was Arequipa, and it went from the pennies to $30, and you only need one of those, don't you? And I can't remember even the names of the others, but they sort of generally went up. So if you're sitting there as an account interested in getting good exposure to the golds, a dozen of these small caps, and the worst that can happen is boredom in one or two of them, and most of them will likely go up in the next advance in gold stocks. And if you're on an exploration one, you could have some big excitement. Now, here's the next part of the story, is that on the rallies, the gold stocks will likely outperform the S&P. So you're going to have the GDXJ outperforming the S&P. Now, you've got equity fund managers out there who may normally not play in the golds. But if they look at a couple of quarters for that sector outperforming the S&P, they're going to have to get in to the hot items, and that will happen. So you're going to go into a world where institutional money that would not normally play the golds will get in because of the outperformance, and I'm looking forward to that one.
All right. Well, this is interesting. So, Bob, just send me that list. We will republish it with your permission to all of our subscribers out there. And it's going to be interesting times. I think what you're describing, although you're not saying it outright, is it's really going to be chaos out there. We're going to have zillions of bankruptcies, planetary bankruptcies all over the place. And all these people that have got to pay back their debts in dollars are going to default. And so we're going to have massive deflation effectively. that they'll try to resolve with inflation because that's the only thing they can do, right?
Yeah. But Mr. Margin gets the central bankers every time. So the contraction will be serious, and the key thing is the price of, or the cost of mining gold go down, and they go down substantially. I can give you a specific example, and that was Homestake. And you could buy the stock in 1930-31 for about $9 a share. And they were mining gold at a constant rate. The price of gold was fixed at $20.67 an ounce. And at the end of 1932, when the S&P had taken such an enormous hit, Homestake was up, the stock was up something like 130%, and their earnings were up something like 130% with no change. Gold was still at $20.67 an ounce, but because their costs had dropped seriously. Of course, I mentioned to the end of 1932 because it was March 1933 when Roosevelt then started messing around with the gold price, and he ended up with it at $35 an ounce, and that then enhanced that the real price was up, and so the government got on board and helped the real price, so that Homestake stock eventually went to $65 on your original $9 purchase. Oh, and man. More than that, in those days, gold miners paid out everything by way of dividend, and it was paying $4 a share dividend in the mid-1930s on a $9 purchase. Gold mining gets very profitable in a depression.
Okay. Well, Never forget that, right?
Yep. Okay, Kerry, we'll send you our list of juniors.
All right. Hey, if you got a question for Bob, just shoot me an email, kl@kerrylutz.com. Hey, we will get you an answer. We're going to get you that gold mining list. Promise you that. If you want it, just send me an email, kl@kerrylutz.com, and put Bob list in the subject line. We'll get it right out to you. Bob, really appreciate you coming on as always, and we will talk to you again real soon.
Look forward to it the next time for sure.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.